Welcome to Insight. Today we're going to share with you some highlights from 2014, as well as some predictions for the year ahead.
Different market participants will have varying views on the performance of the Australian industrial sector in 2014. For many landlords of existing property, especially those with vacancy, it will be remembered as a year of limited market rental growth and sluggish tenant demand. Our leasing operatives have reported very little growth in face market rents outside of Sydney in 2014, while incentives have become more prevalent in all markets. Gross occupier take-up declined in year-on-year terms in all major cities monitored, though Sydney was a standout with a strong finish to the year. Perth also recorded strong take-up last quarter after subdued activity earlier in the year. Overall, take-up nationally was around 15% below the 10-year annual average. Major developers, on the other hand, will view 2014 as reasonably solid. The amount of construction work completed increased more than 34% for the year and was the strongest year since 2008. The majority of take-up last year was concentrated in what we call the new build market. Commitments to pre-lease and design and construct new buildings accounted for 58% of all gross take-up last year, meaning more work for developers heading into 2015. Supply has been led by Melbourne and Brisbane and was the highest since 2008 and well ahead of the recent averages in those markets. The pipeline of projects under construction in 2015 is also highest in Melbourne and Brisbane.
Meanwhile, the investment market has been very hot. Vendors that have cashed in on robust demand and a strong pricing cycle have had a fantastic year. This is especially so for vendors that have enjoyed abnormal value growth from the planning upside that has been bestowed upon them by councils or state governments through rezoning. Total industrial transaction volume in 2014 was a record 4.4 billion, exceeding the previous record set in 2007 and increasing 23% on 2013 transaction volume. A number of portfolio sales and landmark assets were transacted in 2014, setting new pricing benchmarks for this cycle and taking yields for the best quality assets below 2007 levels. The $153.4 million sale of the Super Retail Group properties at Erskine Park and Brendale by Pitt Street Real Estate Partners to QuOP was a standout and was followed by the $94.1 million purchase by Invesco of the Banfield Distribution Centre in Melbourne, leased to Kmart from Goodman. Yields tightened broadly by 50 to 100 basis points over the last year across both prime and secondary grades. The sale of industrial sites with residential zoning or alternative use redevelopment potential was especially high in 2014. Sales volumes in Sydney has been disproportionately supported by residential redevelopment site sales, and this has been heavily supported by the creation of New South Wales Government urban activation precincts around train lines in former industrial suburbs.
This leads to the first of our predictions for 2015 and beyond. We believe rental growth in the Sydney industrial market will lead other markets in the next 12 to 18 months. The combination of tenant movement as a result of urban activation projects, as well as a significantly below average new supply pipeline, has the potential to result in a substantial tightening of rental conditions. Nationally, new supply in 2015 will again exceed 1.6 million square metres, in line with the 10-year annual average. More supply will again be completed in Melbourne and Brisbane than in Sydney.
Yield spreads between prime and secondary assets remain very wide. We believe they'll close further as investors increasingly target better quality secondary opportunities to meet their return hurdles. Up to 75 basis points of tightening for secondary assets is expected in the year ahead. More owners and developers of core style logistics assets will bring them to market as they recognise the opportunity this pricing cycle represents. We will also continue to see new entrants into the market, enticed by the scale and quality of these opportunities. We believe we will set a new industrial sales volume record in 2015, eclipsing the 4.4 billion record set in 2014. We look forward to seeing you throughout the year ahead and exploring our views on the market and hearing yours. Don't forget to check out Insight for all the latest news and research, as well as current industrial sales and leasing opportunities.
And of course, we both wish you a successful 2015.